So get this, PagerDuty just reported a landmark quarter, hitting a milestone they have never ever hit before. So why on earth did the stock immediately tank? Well, that's what we're calling the Profitability Paradox, and we're going to break down their entire Q2 earnings call to figure it out.
All right, here's how we're going to tackle this. We'll start with the results themselves, then dig into that big tug of war, profit versus growth. After that, we'll look at management's game plan, see how Wall Street reacted, and we'll wrap it all up with our official rating in the next call.
Okay, let's get right into it. PagerDuty's Q2 was, well, it was a real head-scratcher. They pulled off this historic win, but investors basically just shrugged. We need to understand why.
And when I say investors shrugged, I mean they ran for the exits. Boom! The stock dropped almost 5% right after the numbers hit the wire. This one number tells you everything you need to know about the market's gut reaction.
And here's why. It's like you're looking at two totally different companies in one report. On the one hand, the bottom line looks amazing. Non-GAAP earnings per share, they completely blew past expectations. And they hit actual, real GAAP profitability for the first time ever. That is a huge deal. But then, you look at the top line. Revenue came in just a hair shy of forecasts, and the real red flag, dollar-based net retention, slowed way down to 102%. That's a massive warning sign that growth from existing customers is grinding to a halt.
And that right there, that's the core conflict of this whole story. You've got management on one side, waving this big banner that says profitability and discipline, but the market's on the other side, and all they can hear is the alarm bell of slowing growth. Let's really pull these two competing narratives apart.
PagerDuty CEO Jennifer Tejada, she put it front and center. Right on the call, she said, "We achieved GAAP profitability for the first time in our company's history." For them, this was the headline. This was the big win, a massive milestone on their journey to becoming a mature, disciplined company.
And this chart just puts the whole paradox on full display. Look at that operating margin on the left. Over 25%. That is fantastic execution. They're running a really tight ship. But then your eyes drift to the right, and you see what's giving investors heartburn. Revenue growth is down to just 6.4%, and annual recurring revenue growth is even weaker at 5%. It's the classic trade-off, clear as day. So let's double-click on that DBNR number, because for software investors, it is absolutely critical. It tells you how much more your existing customers are spending with you year after year. And at 102%, it basically means customer spending is flatlined. Management is blaming this on seat optimization, which is just a fancy way of saying customers are tightening their belts and cutting back. And that, my friends, is a really tough headwind to be flying into.
So management gets it. They see this huge disconnect between the results and how the market feels. The big question is, what are they going to do about it? Well, on the call, they laid out a pretty clear four-part playbook.
They're pulling four main levers here. First, a big leadership change. A new chief revenue officer, Todd McNabb, is coming in to whip the sales strategy back into shape. Second, they're putting their cash to work, bumping up their share buyback program to $200 million. Third, it's all about product innovation. They've got 4 new AI agents hitting the market in Q3. And fourth, and this one is really important, they're shifting away from charging per person to charging based on how much customers actually use the platform. This makes a ton of sense, since underlying usage is actually up more than 25%.
And you can see this whole strategy baked right into their guidance for the rest of the year. They slightly trimmed the top end of their revenue forecast, but they actually raised their earnings per share guidance. The message couldn't be clearer. They are telling Wall Street, look, profitability is our #1 focus right now, even if that means top-line growth is a little sluggish for a bit.
So, okay, if profitability is so great, why isn't the market buying it? To really understand that negative stock reaction, you have to zoom out and look at the bigger picture for investors.
This slide just lays it all out, side by side. You've got management, rightly so, shouting about their historic profit, awesome margins, and strong cash flow. But the market, they've got their blinders on, and they are laser-focused on the negatives. That slowing growth, the weak customer expansion, and the trimmed guidance. It's like they're looking at the exact same report but seeing two completely different companies.
And this chart is why investors are so antsy. Over the last year, PagerDuty stock is down almost 15%. Meanwhile, a general software ETF is up over 26%. That is a massive performance gap. When you're lagging your peers by that much, investors just don't have a lot of patience. They want to see a growth story, not just a profit story.
Which brings us to our final section, the next call. We've looked at the numbers, the strategy, the reaction. So what's our take? Where does the stock go from here? Time for our official rating. So let's ask the big question one last time. A company delivers a historic, profitable quarter, and its reward is a nearly 5% drop in its stock price. What's the call on PagerDuty?
Here's our thesis. For the next quarter, we expect more of the same. Those margins will probably stay really solid, but top-line growth will likely be pretty lukewarm. These big strategic shifts, they just take time to pay off. Because of that, we think the stock is going to be pretty much range-bound until the new CRO, Todd McNabb, can deliver some real proof that the sales engine is starting to fire on all cylinders again. So our official rating is market perform. The company's profitability puts a nice solid floor under the stock, but the catalysts that could really get it moving, like the AI products and the new sales motion, they're just not proven yet. The risk versus the reward feels pretty balanced right here.
This is not financial advice.